The Bank of Japan raised its rate to 0.25% as cautiously expected and announced that it will reduce the monthly bond purchases in a predictable manner, but allow enough flexibility to support stability in the JGB markets. More importantly, the language in the communiqué was quite bullish on prices. The latter hinted that today's rate hike is certainly not the BOJ's last one. Now, all eyes are on BOJ Governor Ueda for further tips and hints. The Japan 10-year JGP yield is pushing higher after the decision and the yen is in demand. Across the Pacific, the Federal Reserve also started its two-day policy meeting and will announce its decision later today. The Fed is not expected to make a change to its rates today but is widely and wildly expected to hint at a September rate cut. Activity on Fed funds futures doesn't only hint at a 100% chance for a rate cut to happen in September, but it also shows that the doves are getting ahead of themselves with the assessment of a nearly 15% chance that the Fed could cut 50 BP or more in September, which will obviously not happen unless there is a big crisis or stress on the financial markets. Therefore, the stretched Fed pricing is a sign that the Fed cut expectations went too far and that we shall see a correction even though the Fed hints strongly at a September cut today, with the risk of hardly upsetting the market if it does not. The aggregate EZ inflation figures are due later today. A sufficiently soft set of data should keep the European Central Bank ECB doves in charge of the market and not let the EUR/USD gain too much strength in case we see a dollar rebound after the Fed decision.